Tomorrow. Not next month, not sometime this year. Tomorrow could be the moment silver miners flip the switch and leave 90% of investors staring at the chart, wondering why they didn't move sooner. The breakout everyone has been waiting for is coiled tight, pressure building. And if this thing releases the way the setup suggests, the move could be fast, violent, and unforgiving. If you blink, you might miss the first leg. Before we go deeper, make sure you hit like and subscribe right now. If you care about silver, gold, miners, and real macro signals that most mainstream channels ignore, you're in the right place. On Past and Profit, we connect history with opportunity, and what's forming in silver miners right now looks a lot like the early stages of past explosive cycles. Let's slow this down and think clearly. Silver itself has been grinding higher. It hasn't been a straight line. There have been shakeouts, fake breakouts, emotional drops that scared weak hands out of the market. But underneath the surface, something important has been happening. Physical demand has stayed firm. Central banks around the world continue to buy gold aggressively. Inflation remains sticky. Debt levels are at historic highs. Real yields move, the dollar moves, but the structural problems in the system don't go away. Now, here's where it gets interesting. Historically, silver miners lag the metal at first. The metal moves, investors test the waters, and then when confidence builds, money flows into the miners. And when that rotation happens, it doesn't drift in slowly, it rushes in. We've seen this before. In past cycles, once miners broke key resistance levels, they didn't just climb, they surged. 50% moves, 100% moves, sometimes more in a matter of months. Right now, many major silver mining stocks are sitting just below multi-month resistance. They've been compressing, lower volatility, tighter price ranges. That's not random. Markets compress before they expand. Think of it like a spring being pushed down. The longer it's held, the stronger the release. If silver holds firm or pushes even slightly higher, that could be the trigger that sends miners through resistance. Why tomorrow? Because markets move on catalysts. It could be economic data, it could be a shift in bond yields, it could be geopolitical headlines, it could be a technical breakout that triggers algorithmic buying. Many large funds use automated systems. When certain price levels are breached with volume, capital floods in. And retail investors often chase after the move has already started. There's another layer here most people ignore: margins. When silver rises by 5 or 10%, a mining company's profit can rise much more than that. Their costs are relatively fixed in the short term: energy, labor, equipment. So when the selling price of silver goes up, the extra revenue drops heavily to the bottom line. That's operating leverage. And in bull phases, leverage works in favor of shareholders. But here's the psychological trap. Most investors don't buy breakouts. They buy comfort. They buy after stock has already doubled and feels safe because everyone is talking about it. Right now, the silver miners are not front page news. They're not trending on social media every hour. That's often how early stages look: quiet, doubtful, uncertain. Let's talk macro for a minute. The US national debt continues to expand at levels that would have been unthinkable 20 years ago. Interest payments alone are becoming a major budget item. If rates stay high, pressure builds. If rates drop, the dollar could weaken and precious metals could benefit. Either path has risks. Either path can support silver in different ways. That's the kind of asymmetric setup long-term investors look for. Add to that global tensions. Supply chains remain fragile. Energy markets are sensitive. Political cycles create uncertainty. In times like these, hard assets start to matter more. Gold often moves first as the monetary metal. Silver follows. And because its market is smaller and more volatile, it tends to move faster once momentum kicks in. Now imagine this scenario. Silver clears a key resistance level. Headlines start to appear. Silver breaks out. Traders who ignored it begin to pay attention. ETFs see inflows. Mining stocks break above technical ceilings that have capped them for months. Short sellers rush to cover. Volume spikes. And suddenly, what was a quiet setup becomes a crowded trade. We've studied past cycles here on Past and Profit. In the early 2000s, bull market, miners multiplied in value. After the 2008 crash, once the Federal Reserve unleashed liquidity, precious metals soared and miners followed. In 2020, during the massive stimulus wave, silver exploded from under $12 to nearly $30 in months, and many mining stocks doubled or tripled in a short window. The pattern repeats: compression, disbelief, breakout, acceleration. Right now, sentiment is mixed. Some analysts say the economy is strong enough to avoid trouble. Others warn that we're sitting on a debt bubble larger than anything in modern history. Markets hate uncertainty, but they also reprice assets quickly when narratives shift. If confidence in fiat currencies weakens even slightly, capital looks for alternatives. Silver miners are leveraged exposure to that shift. Let's address the risk side because that matters. Breakouts can fail. False moves happen. Smart investors manage position size. They don't go all in on a single candle. They scale. They watch volume. They respect invalidation levels. The goal is not to predict perfectly. The goal is to position intelligently when risk-reward becomes attractive. So what makes this moment different? The structure. Higher lows on many charts, tight consolidations, improving relative strength versus broader equity indices, and a macro backdrop that still favors tangible assets over financial promises. When technicals and macro align, probabilities improve. Another factor is institutional allocation. Large funds are underexposed to precious metals compared to historical averages. If even a small percentage of capital rotates into the sector, the impact can be disproportionate because the total market cap of silver miners is tiny compared to tech giants or broad index funds. It doesn't take trillions. It takes a shift in preference. And here's something most retail investors miss. The biggest money is made in the middle of the move, not at the exact bottom. Waiting for absolute certainty usually means paying much higher prices. But entering during compression phases, when volatility is low and structure is building, can offer better setups. Think about the narrative shift that could happen fast. One strong move, one surge in volume. Financial media starts inviting commodity analysts again. YouTube fills with silver to $50 thumbnails. Retail money chases performance. And miners, being more volatile, outperform the metal itself. That's how cycles feed on themselves. On Past and Profit, we don't chase hype. We watch signals. And the signal right now is pressure building. It doesn't guarantee tomorrow will be explosive, but it suggests we're close to resolution. Markets don't stay compressed forever. If you're already positioned, the key is patience and discipline. If you're not, the key is planning. Know your levels. Know your risk tolerance. Understand that volatility is part of the journey. Silver miners can swing hard both directions. That's the price of leverage. Now ask yourself this. If silver does break out and miners run 40, 60, 100% over the next several months, will you be comfortable having done nothing? Or would you rather have a strategy in place, even if it's small and controlled? Regret management is real in investing. It's not just about profit. It's about positioning yourself in front of asymmetric opportunities. Tomorrow could be just another day, or it could be the day the first domino falls. Markets don't send engraved invitations. They move, and those paying attention respond. As we wrap this up, I want you to think long term. This isn't about a one-day spike. It's about a potential multi-month or multi-year trend shift in a sector that has been ignored and undervalued for years. Cycles in commodities tend to be powerful because supply cannot be increased overnight. Mines take years to develop. When demand surges, price becomes the balancing mechanism. If you found this breakdown helpful, comment below and tell me your view. Do you think silver miners are about to break out, or do you expect another fake move first? I read your comments, and your perspective helps shape future discussions here on Past and Profit. And if you know someone watching the markets closely, share this video with them. The more informed we are, the better decisions we make. The clock is ticking, the charts are tightening, the pressure is building. Whether the breakout starts tomorrow or next week, the setup is there. Stay alert, stay disciplined, and stay ready.